By listening to this episode, Interest Coverage Ratio Review, you will be fully familiar with how to calculate, interpret, and utilize the Interest Coverage Ratio (ICR) to assess a company's financial health and make informed investment decisions. Welcome to Got In Early, a podcast about investing in financial markets such as cryptocurrency, the Forex, and the stock market. The Interest Coverage Ratio, ICR, is a financial metric that measures a company's ability to meet its interest payment obligations. It is a critical tool for investors and financial analysts to assess a company's financial health, stability, and creditworthiness. The ICR indicates how often a company's earnings before interest and taxes, EBIT, can cover its interest expense. ICR is an essential tool for investors and analysts as it helps them evaluate a company's creditworthiness and financial health. By assessing a company's ability to pay interest obligations, investors can make informed investment decisions, reducing the risk of investing in financially unstable companies. Moreover, understanding the ICR can assist in identifying financially strong companies that may provide good returns on investment. Calculating the ICR involves dividing a company's EBIT by its interest expense. A high ICR indicates that a company has sufficient earnings to cover its interest obligations and is in a better position to handle debt. On the other hand, a low ICR suggests that a company may have difficulty meeting its interest payments and may be at risk of defaulting on its debt. In this comprehensive guide, we will discuss the importance of the ICR in financial analysis and investment decisions. We will cover the definition and purpose of the ICR, how to calculate it, and how to interpret the results. We will also provide benchmarks for different industries and discuss the importance of comparing the ICR with industry peers. Additionally, we will examine the relationship between the ICR and credit ratings, the limitations of the ICR, and alternatives to the ICR. Finally, we will provide case studies to demonstrate the practical application of the ICR in financial analysis. What is the Interest Coverage Ratio? The Interest Coverage Ratio, ICR, is a financial metric that measures a company's ability to meet its interest payment obligations. It is calculated by dividing a company's earnings before interest and taxes, EBIT, by its interest expense. The ICR indicates how many times a company's earnings can cover its interest payments, providing insight into its financial health, stability, and creditworthiness. The ICR is a widely used tool for investors and financial analysts to assess a company's ability to pay interest obligations. It is an essential measure of financial health, as a company's ability to pay its interest obligations is crucial to maintaining its creditworthiness and avoiding default on debt. A company with a high ICR is considered to be financially stable and in a better position to handle debt, while a low ICR suggests that a company may be at risk of defaulting on its debt. The purpose of the ICR is to provide investors and financial analysts with a measure of a company's ability to meet its interest payments. It is used to assess a company's financial health and stability, determine its creditworthiness, and make informed investment decisions. The ICR is also used by lenders and credit rating agencies to evaluate a company's credit risk and determine its credit rating. Investors and financial analysts use the ICR to evaluate a company's financial health and determine whether it is a suitable investment. A high ICR indicates that a company has sufficient earnings to cover its interest payments and may be a good investment opportunity. On the other hand, a low ICR suggests that a company may have difficulty meeting its interest obligations and may be a risky investment. In summary, the Interest Coverage Ratio is a critical tool for investors and financial analysts to evaluate a company's financial health, stability, and creditworthiness. It provides insight into a company's ability to meet its interest payments and is used to make informed investment decisions. By understanding the definition and purpose of the ICR, investors can better assess a company's financial health and make more informed investment decisions. Calculating the Interest Coverage Ratio. The Interest Coverage Ratio, ICR, is a measure of a company's ability to meet its interest obligations. It is calculated by dividing a company's earnings before interest and taxes, EBIT, by its interest expense. The formula for calculating the ICR is as follows. The formula for the Interest Coverage Ratio is earnings before interest and taxes, EBIT, divided by interest expense. EBIT is a company's earnings before any interest payments and taxes are deducted. It is a measure of a company's operating income and reflects how much money it generates from its operations. Interest expense, on the other hand, is the cost of borrowing money, such as interest payments on loans, bonds, or other debt. To calculate a company's ICR, simply divide its EBIT by its interest expense. For example, if a company has an EBIT of $500,000 and an interest expense of $50,000, its ICR would be 10. This means that the company can cover its interest payments 10 times with its earnings. It is important to note that EBIT is calculated before taxes are deducted. Taxes can have a significant impact on a company's profitability, and deducting taxes from EBIT would result in a lower earnings figure. Therefore, using EBIT as a measure of a company's earnings provides a clearer picture of its operating performance and financial health. Understanding the components of the ICR is crucial in interpreting the results. EBIT is a measure of a company's operating performance, and a high EBIT indicates that a company is generating more revenue than its operating expenses. On the other hand, a high interest expense can be an indication of high debt levels, which can make a company more vulnerable to economic downturns or changes in interest rates. Evaluating the interest coverage ratio. Evaluating the interest coverage ratio is a crucial step for financial analysts in determining a company's financial health and creditworthiness. The ICR provides valuable insight into a company's ability to meet its interest obligations and manage its debt. Interpreting the results of the ICR calculation is the first step in evaluating a company's financial health. The ICR is expressed as a ratio, with a higher ratio indicating a better ability to meet interest obligations. Generally, a ratio of 1.5 or higher is considered healthy, while a ratio below 1 suggests that a company may be at risk of defaulting on its debt. Benchmarks for different industries can provide additional context when evaluating a company's ICR. The ICR can vary significantly depending on the industry and the specific company's financial structure. For example, a capital-intensive industry such as manufacturing may have a lower ICR than a service-based industry such as consulting. Financial analysts should take industry-specific benchmarks into account when evaluating a company's ICR. Comparing a company's ICR with its industry peers is also important when evaluating its financial health. While industry benchmarks provide a general range for a healthy ICR, each company's financial situation is unique. Comparing a company's ICR with its competitors can provide additional context for its financial health and creditworthiness. Interest coverage ratio and credit ratings. The relationship between the interest coverage ratio, ICR, and credit ratings is a critical aspect of financial analysis that investors and financial analysts must understand. Credit ratings reflect the creditworthiness of an organization and its ability to meet its financial obligations. A high ICR indicates that a company is capable of servicing its debt, which makes it less risky to lend money to or invest in. On the other hand, a low ICR suggests that a company is at risk of defaulting on its debt, which makes it riskier for investors and lenders. Credit rating agencies use ICR as one of the factors to determine a company's credit rating. A higher ICR often translates into a higher credit rating, indicating that the company has a lower risk of default. How credit rating agencies use ICR in their analysis. Credit rating agencies like Standard & Poor's, Moody's, and Fitch use ICR as a metric to evaluate a company's financial health and creditworthiness. Credit rating agencies typically have their own benchmarks and formulas for calculating ICR, which may differ from industry benchmarks. Credit rating agencies use ICR in conjunction with other financial metrics, such as debt-to-equity ratios, liquidity ratios, and profitability ratios, to arrive at a comprehensive credit rating for a company. A company with a high ICR may not necessarily get a high credit rating if it has other financial weaknesses or risks, and vice versa. Understanding the relationship between ICR and credit ratings is essential for investors and financial analysts, as it can help them make more informed investment decisions. Companies with high credit ratings are generally considered less risky and more attractive to investors, while companies with low credit ratings may struggle to raise capital or face higher borrowing costs. Limitations of the interest coverage ratio. The interest coverage ratio, ICR, is a valuable tool for assessing a company's financial health, but it does have limitations. It is important for investors and financial analysts to understand these limitations to avoid potential pitfalls and misleading results. Factors not captured by ICR. One major limitation of the ICR is that it only considers a company's ability to service its interest expenses. It does not take into account other obligations that a company may have, such as principal payments on debt or lease payments. As a result, a company with a high ICR may still be struggling to meet its other obligations. Another factor not captured by the ICR is the timing of interest payments. A company may have a high ICR due to a large one-time payment but may struggle to make smaller interest payments in the future. Additionally, the ICR does not account for non-cash expenses such as depreciation, which can impact a company's ability to service its debt. Potential pitfalls and misleading results. Another potential pitfall of the ICR is that it can be manipulated by a company's accounting practices. For example, a company may use aggressive accounting methods to increase its reported earnings before interest and taxes, EBIT, which would artificially inflate its ICR. Similarly, a company may defer interest payments to make its ICR appear higher than it actually is. Additionally, the ICR should not be used in isolation when evaluating a company's financial health. Other financial ratios and metrics should be considered, such as the debt-to-equity ratio and free cash flow. It is important to consider the context of a company's financial situation and industry benchmarks when interpreting ICR results. Interest coverage ratio in practice. Case studies to illustrate how ICR can be applied in practice. Let's take a look at some real-world examples. One company with a high ICR is Apple Inc. As of the end of their 2021 fiscal year, Apple reported an ICR of over 28x. This means that the company's operating earnings are over 28 times the amount of interest expense on its outstanding debt. This indicates a very low level of financial risk and suggests that Apple has more than enough earnings to cover its interest payments. In contrast, a company with a low ICR is Tesla Inc. As of the end of their 2020 fiscal year, Tesla reported an ICR of only 0.2x. This means that the company's operating earnings are only able to cover 20% of its interest payments. This indicates a high level of financial risk and suggests that Tesla may struggle to meet its debt obligations if its earnings decline or interest rates rise. When evaluating a company's financial health using ICR, it is important to consider other financial metrics and qualitative factors. For example, a company with a low ICR may have other sources of cash flow that can be used to cover interest payments, such as non-operating income or asset sales. Additionally, qualitative factors such as management competence, industry trends, and competitive dynamics can also impact a company's ability to meet its debt obligations. In conclusion, ICR can be a valuable tool for analyzing a company's financial health and assessing its ability to meet its debt obligations. However, it should be used in conjunction with other financial metrics and qualitative factors to provide a comprehensive evaluation of a company's financial position. Alternatives to the interest coverage ratio. The interest coverage ratio, ICR, is a widely used financial metric, but it is not the only ratio that investors and analysts can use to evaluate a company's financial health. In fact, there are several other ratios that can provide a more comprehensive picture of a company's ability to manage its debt obligations. In this section, we will explore some of the alternatives to the ICR, including the fixed charge coverage ratio, FCCR, and the debt service coverage ratio, DSCR. Fixed charge coverage ratio, FCCR. The fixed charge coverage ratio, FCCR, is a ratio that measures a company's ability to meet its fixed financing expenses. These expenses include not only interest payments but also lease payments and other fixed obligations. The FCCR is calculated by dividing earnings before interest, taxes, depreciation, and amortization, EBITDA, by the sum of interest expense, lease payments, and other fixed financing expenses. Like the ICR, the FCCR provides an indication of a company's ability to service its debt obligations. However, it also takes into account other fixed obligations, which can provide a more accurate picture of a company's financial health. In general, a higher FCCR indicates a lower risk of default. Debt service coverage ratio, DSCR. The debt service coverage ratio, DSCR, is another ratio that measures a company's ability to service its debt obligations. However, it differs from the ICR and the FCCR in that it focuses specifically on the company's ability to make principal and interest payments on its outstanding debt. The DSCR is calculated by dividing earnings before interest, taxes, depreciation, and amortization, EBITDA, by the total debt service payments for the period. The DSCR is particularly useful for companies with a significant amount of debt, as it provides a more granular view of their ability to service that debt. In general, a higher DSCR indicates a lower risk of default. Comparison and use cases for each ratio. While the ICR, FCCR, and DSCR are all measures of a company's ability to service its debt obligations, they differ in the types of expenses they take into account. As such, each ratio may be more appropriate for certain types of companies or industries. For example, the ICR may be more appropriate for companies with a significant amount of variable expenses, as it focuses on their ability to make interest payments on their debt. The FCCR may be more appropriate for companies with significant lease or fixed financing expenses, as it takes these obligations into account. The DSCR may be more appropriate for companies with a significant amount of debt, as it focuses specifically on their ability to make principal and interest payments. In general, investors and analysts may use multiple ratios to evaluate a company's financial health and make more informed investment decisions. Key takeaways. In this article, we have defined the ICR, explained its purpose and importance in assessing financial health, and provided a step-by-step guide to calculating it. It is important to note that while the ICR is a valuable tool, it has some limitations. Therefore, it is important to evaluate other financial ratios to get a more comprehensive understanding of a company's financial health. In this regard, we have also discussed some alternatives to the ICR, such as the fixed charge coverage ratio and debt service coverage ratio. Some key takeaways from this article include the following. The ICR is an essential metric for evaluating a company's ability to meet its interest obligations. An ICR of less than 1 suggests that a company is not generating enough income to cover its interest payments. Benchmarks for ICR vary by industry, and comparing ICR with industry peers is important for a more accurate analysis. While the ICR is a useful tool, it should be considered alongside other financial ratios to get a more comprehensive understanding of a company's financial health. Best practices for utilizing ICR in investment decisions include analyzing trends in ICR over time and comparing ICR to industry peers. By following these best practices and considering the limitations and alternatives to the ICR, investors can make more informed investment decisions and gain a deeper understanding of a company's financial health. Conclusion. The interest coverage ratio, ICR, is an essential financial metric that investors and analysts use to evaluate a company's ability to pay interest expenses on its outstanding debt. In this article, we have provided an in-depth analysis of the ICR, including its definition, calculation, and interpretation. We also explored its limitations, alternatives, and practical applications through case studies. ICR is a critical tool in financial analysis as it helps investors and analysts understand a company's financial health and how it manages its debt. By comparing a company's ICR to industry benchmarks, investors can gauge whether the company has the adequate cash flow to pay its debt obligations. Understanding a company's ICR can help investors make informed investment decisions and reduce investment risks. It is important to note that ICR is not a standalone metric and should be used in conjunction with other financial ratios and metrics to gain a comprehensive understanding of a company's financial position. Moreover, ICR should be used as a comparative tool, and investors should compare a company's ICR with industry benchmarks and its peers. In conclusion, the interest coverage ratio is a crucial metric that investors and analysts use to assess a company's financial health and investment potential. By understanding how to calculate, interpret, and use ICR, investors can make informed investment decisions and reduce investment risks. In the end, we hope that by listening to this podcast you will be fully immersed in what you were looking for. You can help us improve by sharing this podcast, which is published in ADAS Investment Magazine, and help optimize it by submitting your comments.